Hello, and welcome to another session of our, education series called Moneyfy Mantra, where we speak with industry experts on various personal finance topics. Today, we have with us Mr. Aashish Somaiyaa, CEO of WhiteOak Capital Mutual Fund. Ashish, a warm welcome to Moneyfy Mantra.
Thank you. Thank you very much. Thanks for inviting me.
Yeah. So a quick introduction about Ashish. Ashish has been in the industry since last 25 years. Prior to WhiteOak Capital, he was the CEO and managing director of Motilal Oswal Mutual Fund, where he has sort of scaled up the AMC business from 1,300 crores of AUM to 42,000 crores of AUM, where they have grown 30x over a period of 7 to 8 years. Ashish, before we start the session today, let me put some context, for our viewers today about the market. So India grew by around 8% in terms of real GDP last year, and it is expected to grow by around 7% this year. We saw a booming market where our Nifty is at all-time high over the last 2 or 3 months. It's coming up and down, but in the last 1 year, we have seen 25% return in Nifty itself. And over the last 5 years, Nifty has compounded by around 18%. On the other hand, mid caps have also rallied quite a bit. Why, in the last 1 year, they have given around 50% return. And over the last 5 years, we have seen a compounding rate of growth of around 29%. Similarly, over the last 1 year, small caps have also boomed by around 46%, and in the last 5 years they have compounded by around 34%. I think we are in a fairly good market where our GDP is growing consistently over the last 3 4 years. We also saw we are now close to around $4 trillion economy, where we are amongst the fifth largest economy in the world. However, we are still amongst the laggards in terms of GDP per capita at around $2,700 per capita. On the other hand, we have also seen our market capitalization reach $5 trillion worth of overall market capitalization of India. On all the stocks, if I sum it up, we are now $5 trillion dollar market cap. If we see this ratio of market cap to GDP, we are above 120%. Last we saw this when in 2007, where we were on a similar levels. In fact, in this year we also crossed 140% and it slightly came down. So Ashish, our first question for today, explain to us what constitutes a market boom, and what are the key economic indicators of that.
See, I think, it's a well-known fact and, almost to an extent a cliche that the stock market is more like a barometer of economic performance, right? Clearly, the stock market exuberance comes from the economic exuberance, or, from the economic performance. Now, and, obviously the stock market is the leading indicator. So a stock market is not just the barometer, it is also the forewarner of the times to come. Right. And if at some point in time, the realities of the economy or the reality of the corporate performance, if it doesn't keep pace with what the stock market is discounting as a leading indicator, then of course, at some point in time, the stock market has to come back and, it cannot lose its anchoring or tethering to the fundamentals. But as you can see, you mentioned that last 5 years, Nifty has compounded at 18%. Now, one can always keep discussing that long period average is say 12 to 15%, but last 5 years is 18%. Last 3 years is much higher. So, are we too expensive, etc. The reality is that in last 5 years, when Nifty has compounded 18%, the earnings growth of Nifty companies, as reflected in Nifty EPS, that has also compounded at about 18%. So clearly, while the market is higher when you compare it to its relative past, right? When you compare it to history, market is higher. But I don't think that at least Nifty or the large cap, I don't think it has lost its linkage with the actual economic or actual corporate performance. Correct. So market has gone up and it has rewarded people, but I think it is not without fundamentals or not without merit. That is one thing to keep in mind. Second important thing to keep in mind is that post-COVID, the broad-based economic growth, there is a broad-based participation across sectors. See, in the past, if you see pre-COVID, if you specifically see periods like 2015, 16, 17, 18, the economic growth used to be quite narrow. Most points in time you saw services growth. At some points in time you saw consumer growth. Investment activity was very, very poor. But if you see in the last 3 to 4 years, right, investment activity led by government has picked up a lot. Services growth has also played well. And in fact, domestic manufacturing, say company, sectors like say electronics, for example, a lot of these have also participated. Consumption, well, yes, it has been discussed that it has been more urban led and not so much rural led. And that is something which will get corrected over a period of time. But I think that broad-based economic growth is what is reflecting in the markets, and also it is backed by earnings. So I think the market is on merit. I don't think that there is any outlandish, exuberance really. So people should obviously keep participating. Only thing to keep in mind is that people get carried away with recency bias. So last 2 3 years, if small caps, PSUs, railways, energy, defense, last 2 3 years, if these things have worked, people start extrapolating that this is what will work in future. But market has its own way. Market works on relative valuation. Market keeps rotating from different market caps and different sectors. And I think it's important to keep the portfolio broad-based and balanced. I think that is what is important, not to get carried away.
So I think, with this, our next question is, how should an investor construct their portfolio in such times? Should they be, diversifying across multiple asset class? If so, what kind of portfolio should an investor construct right now?
See, portfolios, irrespective of what is happening, portfolios should always, follow a certain asset allocation. Everybody has certain goals and everybody has certain risk tolerance. And for meeting their goals, everybody has certain return expectations. It's in the nature of market. Sometimes it will disappoint you and it will give you much less than what you require in your portfolio. And there are times like this when it will surprise you on the upside and reward you a lot more than what you have initio expected. Correct? So in times when the market is rewarding you a lot more than you expected, you should be correcting your asset allocation and making it a bit more broad-based and more defensive. And in times when the market disappoints and gives you very low return, that time you should be willing to actually allocate more, because ultimately it will average up in future. So I think, asset allocation has to always be done counter-cyclically. By and large, people make the mistake that they are pro-cyclical, meaning if equity is rewarding them, they will invest more and more in equity. That is pro-cyclical behavior that works in the short term, but it doesn't usually end up very well. For successful investing, you have to be counter-cyclical, which means that if equity is going higher and higher and higher, that means you should be allocating less and less, and you should make sure that your portfolio, because see, if equity rewards you more than what you expected, one is that there is an intrinsic propensity to keep putting more. And second is, on an allocation basis, it is the equity which is appreciated. So the allocation of equity will anyway go up compared to fixed income or any other asset class. So I think at times like this, like I said, you have to be counter-cyclical and you have to rebalance your portfolio. You should not get overexposed to what has been working very, very well. And you should not be underexposed to something which has been not working so well.
Sure. So, Ashish, with this, I think the next question is related to, some sectoral allocation. So, at times when, already mentioned that, cyclical versus non-cyclical companies, but, at this point in time, which are the specific sectors, which one should look at, in this heated market?
See, I think what one should be wary of is easier to, talk about, because I've seen this kind of market in 2007, 8 also. I think this time fundamentals are much better. And this time India's external positioning is much better. So to that extent, it is different. But let me also tell you similarities. Like, see, when the market runs up, like say, for example, today, what is the popular narrative? The popular narrative is that the government is investing in infrastructure, in ports and roads and railways and defense. And, the government is rolling out orders, and everywhere the government is leading the capex. So the companies which are providing services or providing products or providing goods to the government and playing a role in the government's investment cycle, they are the ones which seem to be benefiting the most. Correct? And nowadays, what I'm seeing on social media or certain places, people are, collating the order books of different companies and saying, that, okay, these companies have such big order books that they are going to do very, very well. Now, we all know that ultimately, when you value a business, many times it is said that the value of a business is present value of its future cash flows. It doesn't say present value of its future order book. It doesn't say present value of future EPS or PAT. It specifically says present value of future cash flows, right? And past examples or past experience of 2006, 7, and 8 has taught us that all growth doesn't result in profits. So all order books are not going to result in free cash flows exceeding the cost of capital, right? So one has to be careful when, market, instead of being driven by cash flows and profitability, when stock prices of companies just get driven by their order books. I think order after receiving the order, it has to be fulfilled in a particular timeline, and then a payment has to be received, and then it has to result in free cash flow, and that free cash flow has to exceed the cost of capital. All this has to happen, but nowadays, instead of free cash flows, market is focusing on order books, and that usually doesn't end very well. We have seen it in 2006, 7. So the stuff which is flying just because of government's investments, I think it is good, but I think it has gone up a lot, and there is no margin for error out there. So that is something to be careful about. The stuff which seems to be headwinded, for example, anybody and everybody will tell you that IT is not going to do well because of US economy, correct? Now, how much is it because of US economy and how much is it just because interest rates have gone up and discounting rate has gone, correct? So I think as a contra sector, say for example, IT and digital is a good bet. In last 3 years, market has been fully in favor of oil, metal, energy, defense, and market has been anti-ESG. But in the long term, good governance and free cash flow is what works. So we need to invest with companies which have good governance and good quality. Then, for example, banking, right? 50% of our index is banking, IT, consumer discretionary, pharmaceuticals, and these kind of companies. But this is what has been underperforming in the last 2 to 3 years. So we are bullish on the market. Market has to sustain its performance. But if market has to sustain its performance, then what has gone up a lot in the last 2, 3 years will take some rest. And what has underperformed is what is actually, going to witness some rotation in its favor. And that's why I think portfolio should be broad-based.
Yeah. So, with this, I think we'll move to our next round, which is our money fire round, where we will ask you quick questions, and I would request you to answer them as candid as possible. What do you think, about the current market and economic phase? Is it a sustainable boom or a speculative bubble?
No, it is clearly a sustainable boom. I have no doubt in my mind. It's definitely not a bubble.
Yeah. So as an investor, there's a good saying right now, risk hai to ishq hai. Which investing risk profile would you category yourself? High risk or low risk?
No, I'm clearly a high risk investor. My risk tolerance is very high.
Okay. So which amongst the following is the most preferred investment option, and why? Mutual fund, direct equity, FDs, or bonds?
Mutual funds. I mean, first will be mutual funds. There's no doubt about it.
So you can rank, the categories 1 to 5, 1 being the most preferred and 5 being the least preferred. Which categories would you prefer? Large cap, mid cap, small cap, flexi cap, multi cap, or sectoral or hybrid?
See, first will be flexi cap. Then it will be multi cap. Then it will be large cap, and then the rest.
Sure. What investment style would you prefer? Active management or passive management?
Active. There is a lot of scope to generate alpha, actually.
In the current market scenario, which asset class looks more promising and less volatile? Bonds, real estate, gold, or silver? I'm not considering equity because it's generally more volatile.
I would say gold.
If you had 1 crore, to invest in a global sense, which market would you prefer amongst the below? Indian markets, Chinese, Japanese, or the US?
First India, second US.
Great. So, I think we have some more follow-up questions on your on your answers. We have seen that US market give an excellent returns, and you have the world giants in the US market. And why India before US?
No, see, I think it's like this. If you see, in your opening remarks, you mentioned that in India, the per capita income is $2,700, correct? See, growth, and more importantly, not just growth, alpha, meaning, additional return over the index. It will always be possible in the market where there are imperfections. So let's take an example. If you say US, see, US is obviously the mecca of all innovation. It's the world's leader in technology and innovation, right? And all original ideas, they usually come from the US. So US will always be a front runner, or a US will always be at the forefront of capital market and always be at the forefront of equity investing. I have no doubt in my mind, correct? But why did I say India first? Because I think the potential for returns, and more importantly, the potential for alpha over the benchmark, is much higher in India. Correct? Let's take an example. In US today, a lot of the alpha is captured by private equity. Right? In US, the listed public equity space is actually shrinking. I can give you just one statistic. In last 25 to 30 years, the market capitalization of all listed companies in US has gone up 4x, from 13 trillion to well over 50 trillion. But the number of listed companies has gone from over 7,000 to about 3,500. So in US, a lot of the investment activity is happening in the private space because institutions put bulk of their money. Market is institutionalized, and institutions put bulk of their money, like 60-70%, in the private market. Buyout funds, pre-IPO, VC, PE, growth funds, those kind of things. Right? Whereas in India, but day by day, the best of companies are still coming to the market. I'm told this year, US, SpaceX might come with an IPO. So imagine what you need to do for stock picking and for generating alpha in the US. In India, save bhujia, potato wafer, and baby's clothes. These are the kind of things which are still getting listed. So there we have a long journey in front of us, a lot of stock picking to be done, a lot of potential for return. So India will always be top priority, and then it will be US.
Great. So I think as we mentioned, some bit of the US market. We are seeing that the global market could also enter into a recession, and we are potentially seeing a lot of risk with the currency or the exchange rates in India. What are the potential risks of investing in a current market scenario, and how can the investors mitigate them?
See, there will always be risks in investing in equity. There is no doubt about it. Correct. And second is, you cannot fully mitigate equity risk. The only thing what you can do is to ensure you don't invest so much that you lose your sleep at night. You only invest that money in equity. If it is down 30-40%, you should still be able to sustain, and it should not impact your lifestyle at all. So only put your risk money into equity. So there's no way to fully mitigate risk. The only way to do it is to asset allocate and cushion your risk such that you can tolerate and you will not get sleepless nights if equity depreciates. That is first thing to always keep in mind. Now coming to the second part about the risks. I think that if there is any correction engendered in the Indian market because of weakness in US economy, let me tell you, not only will it be short-lived as far as India is concerned, it will also be a great buying opportunity. I have seen it time and time again. Whenever our market falls because of external macros, like say something in US or some, those kind of disturbances. In sympathy, in the short term, all stock markets are correlated. In the short term, the global stock market is one stock market. So if US market falls, in sympathy, our market will also fall. But ultimately, if the US economy goes through a period of slowdown or recession, it will be backed by rate cuts. If they cut rates, dollar will depreciate. If dollar depreciates on a relative basis, emerging market currencies and Indian currency would appreciate. And typically, phases when our currency is appreciating is always followed by huge amount of foreign inflow because it adds to their returns if our currency appreciates. Correct. So I'm not very worried about US slowing down, etc. I think that in the last 2 to 3 years, or more so in the last 10 to 12 years, the biggest challenge for emerging markets like India has been that US, which is the 1,000-pound gorilla, they have been just absolutely rocking, correct? So if US economy grows 3.5%, and if US stock market delivers 8-9% in dollar terms, then who needs to invest outside US, right? But if the US slows down, if the dollar depreciates, and if emerging market currencies become more competitive, our market will actually outperform, and we'll get a lot more positive flows from outside.
Correct. So, I think we've already seen, a lot of, business cycles in terms of economy booming, and then, there's a slowdown. In the past 2 decades, we have already seen, 2 or 3 such cycles. If you could highlight, some of the learnings which you had, over the past 2 decades, what would it be, and how do we, cover our portfolio with that?
See, I can tell you only two things, which is my salient learnings. One is, like I already mentioned in response to your previous question, in the short term, all stock markets get correlated, right? In the short term, the global stock market is one stock market, correct? So if there is any disturbance in US economy or anywhere, if their market falls, in sympathy, our market would fall. But that is only the short term. In the long term, our market will deliver in line with our corporate earnings, and their market will deliver in line with their corporate earnings. Now, as we discussed earlier, in the last 3 to 4 years, we have seen a resurgence in corporate earnings, and we are in a good wicket. So I remain confident about our corporate performance and our stock market performance. So one thing to always remember is that if our market declines because of any external news, it will be temporary. It will be a buying opportunity. It will be only short term, and in the long term, our market will deliver in line with our economic performance and our corporate performance. That is one thing. Second thing to keep in mind is what we discussed along this conversation, which is that however convinced you may be about any asset class, the point is that your portfolio should be such that performance or underperformance of any asset class should not hurt your subsistence and should not give you sleepless nights. So portfolio should always be balanced, asset allocated, and diversified, right? And portfolio movement should be counter-cyclical. You should be adding to the asset class which is underperforming, and you should stop just keeping on blindly allocating to the asset class which is outperforming. You should avoid recency bias. And last thing I'll tell you is that investors, they are very deterministic. If they think equity will work, they think only equity will work. If they think debt is not going to give return, they think debt will just not give return. It doesn't work that way. For success, you need to be probabilistic. And people who do who does asset allocation? Only people who are probabilistic, they will do asset allocation. So for success, you need to be probabilistic. The biggest mistake most people make is that they are very deterministic, and that's not really a recipe for success. So these are a few things that I just wanted to share with you. I hope they are useful.
Yeah. I think it gives a lot of insights, to our investors. I think last point is related to the current market scenario. Now, as you would know that India has already crossed around 9 crore mutual fund accounts, and your message to these 9 crore users, I think some of the learnings which you shared will definitely help them. But there's a saying that time in the market is more important than timing the market. So what is your final take on that?
Yeah, I mean that is indisputable. It's very appropriate, very apt. I'll put it differently. A lot of time people watch Hindi movies. In a Hindi movie, when there is a tough situation, when the protagonist is going through some trouble, some elderly person will advise them that beta waqt har zakham ko bhar deta hai, right? I don't know how true that is for life situations or for the movies, but that statement most applies to stock markets, correct? Because every 18 to 24 months market makes a new high. Correct. Every 18 to 24 months market makes a new high, and we are blessed to be in an economy which is an upward trajectory. So yes, it may not be true for all markets and all situations, but in India, definitely it's true that if you spend enough time, you will be rewarded.
Correct. So I think, Ashish, we have come towards the end of our session for today. It was great speaking with you. I hope our viewers, would take away the key pointers. To all our viewers, if you are planning to start your investment journey into mutual funds, don't forget to download Moneyfy by Tata Capital. You can start an SIP with as low as rupees 500. Additionally, we have a team of experts waiting to assist you for every step by step assistance on investing. Further, if you already have a large investments, we can help you out. Manage your overall investments and give you a one single dashboard for tracking all your mutual fund investments. Ashish, thank you for joining us today. I think this is one of our best sessions which we could address at this time.
Thank you for inviting me. Thank you.
Thanks, Ashish. Have a great day.